Hey guys, Mike here. So I had some really good conversations and some questions following up on the video I did a couple of days ago about the S&P and everything, and whether the stock market is going to do a correction or not. And so one of them was a conversation between one of our members who brought some stuff to my attention. As you can see right here, it's from KM, and it said, I've been looking at RRPs relative to margin debt and the stock market. We saw a spike in margin debt and retraces, and it retraces just before the dot-com crash and 08 crisis and other sell-offs. RRPs run inverse to margin debt. There's a chart out there, part of a study released in PDF format that you can Google. And so as you can see, we went through this long back and forth, and they sent me some links and stuff like that. And somebody else jumped in the conversation. And so I want to bring that to your attention because it really is good information to put out there. And it kind of is somewhat of an indicator, actually. And so the other one is, some people had questions about, well, how could the stock market, go through a correction when the economy is so strong and all this stuff. And then somebody had a question about bonds and that. So I'm going to go through those things because I think they're very important to know, so you're not surprised when something does actually happen here. So let's go ahead and jump right into it because it's a lot of information, okay? And so the first thing I want to go into is this margin debt. And this chart ought to give you pause. I mean, you ought to see this and go, wow. That is a lot of margin being used right now. So you look to the left, this obviously takes us from 95 to 2000. It looks like quite a bit. These are in billions, by the way. Quite a bit. Then, of course, we end up having the dot-com bubble, boom, and we end up going into positive balances. And then here's our way. Look at the little bit of margin, which I guess seemed like a lot back then, that was being used before the crash when the housing market almost took us down. And so you see that right there. And this is the S&P, of course, right here, this little trend line right here, this little line you see moving up and down. And so then all of a sudden we come out of that when we hit 2010, and it's okay. We get back to about the same levels as 05 to 07-ish. And then 2013 hits, and we take off like a rocket. I mean, look at the amount of margin. I mean, they're just handing out like candy, and you see the S&P just start skyrocketing up. I mean, just taking off like crazy. And of course, you see where it's at now. I mean, it's just astronomical, okay? It's just mind-boggling when you think about it. And if we take a look at another chart, I think it's easier to see it here. Whenever you see margin debt start to decrease, it precedes the market movement down, okay? It precedes the S&P movement down. You can look over here at March 1st, 2000. Margin debt starts to decrease, and then 8-1, 5 months later, the market falls off a cliff. When you look over at 07, 7-1, 2007, margin debt starts to decrease, okay? And then 10-1, 3 months later, market falls off a cliff. And then when you look up here, you can just see as you follow it along, you can see if you look close enough to where margin starts to pull back in any dip here, heading up towards 2021. And then the market proceeds to fall. And so if you look right here to the right, all the way to the top, at the very top, you see right now, it is heading like a freight train heading north right now. So as soon as we start to look and see whether or not that is actually decreasing, and this actually comes from July 2021, so this shows June numbers where margin debt was still increasing by 2.5%, then that's going to get to tell us whether or not the market might be moving south into a correction or worse. And so that's an indicator I will be paying very close attention to. It moved up like 1.5% in May, 2.5% in June according to this data. You can see it still rocketing up, but when it does turn, and it usually proceeds anywhere from a month to 5-6 months ahead of time, you can bet money. And of course, that's predicting the crashes, the corrections. It only does a little bit of movement, and then you see a massive correction. So for the corrections, I would say anywhere from, 2 weeks to 6 weeks, somewhere in there. And so as soon as I see that thing take a dip, which the problem is it only reports every month, so we could be in the middle of it. It could be happening, basically right now in July. We wouldn't even know about it until August. But, I find it very fascinating, and the amount of margin. I didn't realize we use that much margin, my Lord. That is crazy. That's a lot of leverage out there. And so if you're wondering why, which I'll get into this a little later, why, these people out there like Michael Burr and all these other guys are saying if the bond market collapses, it'll be the worst crash in history. There's two reasons for that. One, because the bond market is worth like $40 trillion. And I forgot, I actually wrote this down. It's like $46 trillion in the US, $119 trillion around the world, right? So if that collapsed, then you're also talking about on top of that, that would bring down the stock market with it. Well, guess what all that margin debt's going to happen? Everybody's getting margin called, right? And so it'd just be this straight down. And so that's kind of one reason they talk about that, because we're so highly leveraged right now, and more than we've ever been in history. And so, yeah, that's interesting. So I wanted to bring that to your attention. I thought that was interesting. I would definitely be keeping a close eye on this report, and I want to appreciate remember for bringing that to my attention. So I'll definitely be looking at that more. And the other one they were talking about, which was the reverse repurchase assessments. Okay, so RRPs. And so, you know, if you look at this chart right here, and so this shows the reverse repurchase agreements by the Fed, and this is a tool used to control short-term interest rates and ensure there's enough liquidity in the market. And so that's why this is basically how they flooded the market with liquidity when the whole crash happened. And you can see it's flat, right, in the first of 2021 as well as last year. And then all of a sudden comes really, I guess, April, May, it starts to ramp up. And in June, you see it absolutely skyrocket, and still very high in July. And what's happened is the banks are basically saying, here's this money back, which is taking money out of the market, right? Because they want to get this new kind of rate they came up with, because they actually just barely increased these rates right here, which you'll see. And as you can see right here, this is on June 30th, 2021. Fed's reverse repo spiked to $1 trillion. Cash drain undoes 8 months of QE. This is the money they're taking out of the market now. And so they said right here, if the Fed at its June meeting doesn't tweak its offering rate for overnight reverse repos and the interest rate on excess reserves, my guess is that by June 30th, end of quarter, the amount of overnight repos could spike to $1 trillion. The Fed then increased these two rates by 5 basis points, and today that cash drain operation shot up to nearly $1 trillion. Now I found this interesting when it says, this month's Fed scare showed us just how sensitive stock prices are when it turns out there's an alternative to stocks, right? Because everybody's had to basically invest in stocks. There's been no alternative. Nobody wants to buy bonds and all that stuff. The Fed raised rates fractionally off the floor by offering 0.05% instead of 0% on its cash-absorbing reverse repurchase agreements, a kind of overnight security deposit, and instantly sucked in $235 billion extra. Talk of rate increases coming in 2 years instead of 3 years, previously projected, added to pressure on stocks, and the S&P fell just over 2% in 3 days before resuming its upward climb. And so, of course, this could explain what we just went through. The minor sell-off there was, liquidity was coming out of the market. The only thing that kept the markets moving so far from last year to this year is the liquidity that was flooded by the Fed and the government with all the stimulus checks and things of that nature. And so it probably spooked the markets. That's why you saw the sell-off. If that continues, we'll get to see exactly where we're heading from here. But liquidity is the key, all right? And especially the Fed propping up the bond market, which is what I touched on earlier. They're buying so much of the bonds that there's a scare factor in there. That's why people say the bond market is in a bubble or something, because basically what will happen is the risk is, and I think the Fed is painting themselves in a corner, to keep this simple, which is what they don't know. If they stop purchasing, is there going to be somebody to come in, or investors to come in and actually pick up what they're not purchasing, right? And why would they? I mean, I don't understand why they would. There's nothing there, worth it for them. They're not going to be getting a return on their investment, which is why the other scare is they're going to have to raise rates to encourage people to buy these bonds, okay, that if they decide to ramp down on that. And so that's a whole nother issue, and I don't think the Fed knows what to do right now. I think they're stuck, where they're kind of slowly, really moving really slow, trying to ease off a little bit to see if people will pick up and actually buy those bonds. And if they don't, what are they going to do? They're going to have to raise. They're not picking them up. We got to raise rates. Of course, raising rates scares the heck out of the stock market, especially growth stocks, and they start heading south. So as a whole, it's a delicate situation. I'll be honest with you. It's a delicate situation. And so that kind of leads us into the other question of, hey, why would the stock market go into a major correction if the economy is strong? And it's like, well, I think we saw last year the economy and the stock market somewhat, they aren't the same thing. You know what I'm saying? They just aren't the same thing. And it definitely was a detachment from last year when you saw the economy come to a grinding halt and the stock market took off. But should they coincide? Somewhat. If we're in a recession and the economy growth is slowing, usually you see stocks trend down and start to trade sideways and stuff. But the one thing you got to understand is and I think the government's figured this out a long time ago, our economy in America is so dependent on our government. Like, everybody thinks we're a capitalist society, and we are to some degree, but we've been a hybrid for years of, and take politics out of this, capitalism and socialism. Social Security, Medicare, Post Office, VA, all that stuff, that's socialistic type, institutions and policies right there. That's not capitalism. Plus, even in our capitalist society, they depend so much on government subsidies, tax breaks, all this stuff, right? Without it, forget about it. The government, you'll see this in the chart, buying bonds like crazy even before the '08 crash, okay? And so there's just so much that is, that all these publicly traded companies, oil and gas, alternative energy, depend on to continue to grow and this economy continue to churn. And I'm going to kind of show you that right now. As soon as you can wrap your brain around that, of how dependent we really are on the government at local, state, and federal level, then you understand a little bit more about the stock market and the game they play and how much they depend on the government. And if you look right here, and we'll start off right here. I mean, this is the deficit you see. The last time we had a surplus was 2001. They finally figured out that's terrible for a growing economy. So they started increasing, and they ramped up in the '08 crash, started coming down. 2016 to 2019 was supposed to be a great economy, but guess why it was great? The deficits, right? The government spending more money on defense, more money on government contracts, all this stuff, these contractors, and then of course a crash happens, boom, the government just floods money in, right? Just floods it in. And then if you look just on jobs, like look at this right here. This is by, it says percent of share of employed population over the age of 16 who work in the government. And this is broken down by state. I think this is from 2018, so the latest I could find was probably higher than this. But most states, it's like 1 out of every 6 jobs is a government job. Some of them are 1 out of every 4 in the state is some type of government job, whether it's local, whether it's state, federal, whatever. So look at all those jobs that work for the government, right? So basically, I guess in America you say, what, 1 out of every 6 or 7 jobs is a government job now all of a sudden. And that's grown immensely over the years. And then right here you can see, here's in billions of dollars, the Federal Reserve and their portfolio of treasury securities, right? You see, this is actually what they've been purchasing. You have bills, notes and bonds, inflation index securities. Look at what has been taken up, notes and bonds. That's what they've been buying. Look at the dates. Going back from 2007, 2008, 2009 was flat, very low, and then they just ramped it up, kept ramping it up even through the good years and stuff like that. And you know this because you go right over here to this one, which I love more than anything, the Fed's total assets from crisis to crisis. And you can see that's what they're purchasing. That's what their balance sheet is, right? This is in trillions. And the same thing, it was flat through 2007 to 2009. Then they started ramping it up. 2015, 2018, and 19, mostly flat. And then boom, skyrockets up in 2020 and still continues to ramp up. But just look how much they ramped it up from '09 just through 2015. I mean, that shows them basically propping up the bond market. And if you don't believe me, I mean, here's a guy from BlackRock. They manage about $9 trillion.
If you want to know why stocks are doing what stocks are doing, you probably have to start with why are bonds doing what they're doing. Well, look, full disclosure, I did not think we'd be talking about a 115 10-year with the best growth we've seen in the United States in several decades. So it's pretty inexplicable. I mean, Rick Reeder was on before. He spoke about a lot of, I think, what's been going on. You've got record liquidity. You've got a dearth of high-quality assets. And you've got international bids coming in that once you hedge back treasuries to pick your spot, yen, euros, they look more attractive than what's on offer in many other countries. Having said all of that, I think those explanations tell you why the 10-year is not at 2%. It's not clear why you should be a little above 1%. Our best view is still the fact that real rates are too low. A negative 1%, that's completely inconsistent with anything you saw even last decade, which was a slow growth decade. So we still think you're going to see some backup in yields. It's not going to be enormous, but I think where we are today is too low relative to what we're seeing in growth. And the fact that at some point, the Fed's going to have to take their foot off the gas pedal a little bit.
And this is the one thing that's got everybody really nervous about the S&P is the FANG stocks. They keep making all-time new highs. These trillion-dollar companies are just basically dragging the S&P up higher and higher. And the question is, how long can they keep it up before they stumble? And people are saying their earnings are going to have to be absolutely spectacular, and they're going to continue to grow at such rates that they don't know if it's even possible to do, especially once stimulus stops coming out. No more stimulus checks, people having to go back to work, that kind of stuff. Are people working without and not getting the stimulus checks? It's just less money going into these companies. And so that's what's got everybody really nervous. Like, how long can these trillion-dollar companies continue to push up the S&P? And so, and the stock market in general, because if we stop getting stimulus checks, if the government stops pulling back on bonds, and you give investors another alternative, and they start going into bonds, well, guess where that money's got to come from? It's got to come out of the stock market, right? It just has to. And eventually, there's not going to be all this money going into the stock market, because now there's less stimulus coming out. I mean, I don't know how much more stimulus we're going to be getting. Maybe we'll get some more, but that's going to dry up, right? And so another thing, and that's as a side note, why the government will absolutely regulate crypto soon. And they're all, that's why they keep talking about it. Janet Yellen's all over them about doing it, because if people put money into crypto where they can get those huge returns, why in the world would they ever go to the bond market? That would make no sense, right? And you got a lot of rich people doing crypto too, and institutions as well, right? And then some of that's coming out of the stock market as well. And so, you know, they had that thing with Kathy Woods, the B, whatever the heck it was called yesterday. I actually recorded it and didn't put it out, but you know, Kathy Woods and Elon Musk and Square CEO were talking about, you know, Bitcoin and stuff. All of a sudden you saw crypto rise, take these big gains and stuff like that. But, you know, that's kind of here to stay, but they're going to regulate, you can guarantee, because they know if a lot of money starts flowing into crypto, which it is now, it's not going to go back into the bond markets, that's for sure. And it sure as heck ain't going to go back into stocks, right? And so that worries them. I can guarantee they stay up late at night trying to figure that one out. And so that's kind of where we're at. You know, everybody's putting out these crash videos, which I'm sure they can doing that, and, you know, everything else. But look, is there going to be a correction? I can't imagine not in the next at least 1 to 3 months. You know, but this is stuff I'm going to be watching. I'm definitely going to be watching when margin, and when I remember for that, you know, it starts to pull back, as it pulls back preceding a move down. And so I'm going to be looking into that. You know, we're going to see what happens, you know, with the Fed, as far as if they stop buying these bonds, start trying to like trim it down and stuff like that, and see if somebody else is going to pick up that surplus of bonds and see what happens. Or they're going to have to raise rates. And if they raise rates, you can guarantee that's going to scare the heck out of the market, and stocks are definitely going to take a hit. I'm just saying, it's just life, okay? But it's okay. That's why I'm saying have cash on the side waiting to go. You know, that's when you make your big money right there, not buying at all-time highs, okay? And so it's not a bad thing. It's just painful to go through and psychologically sucks. But anyway, I wanted to put that out there to you. Thank the members and people watch this channel for bringing some of that stuff out here, and keep bringing it to me. I'll put it out here. Don't bother me if it makes sense. You know, and I try to keep it as simple as possible. Sorry if it wasn't. Anyway, if you got some out of it, hit the like, subscribe button for me, guys. I really appreciate that. Hope you guys have a good weekend, and whatever you do, don't forget, hit that link down there in the bottom of the description. Open your account with BlockFi. You can earn interest there. Also, they're getting ready to start rolling people off the waiting list for their credit card, where you can earn Bitcoin on your purchases, and it is a 0% annual fee, so it doesn't cost you anything to actually have.